Coming up in today's show, stocks finish higher today but down for the week, some bullish and bearish research, oil closes at new year-to-date highs, a preview of the new iPhone 15 due out Tuesday and what it means for Apple and the stock market, and how you can get my latest custom indicator for TradingView, dark pool percentage. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. My name's Jared and I hope you're having a great Friday, Saturday or Sunday, wherever you are in the world. And before we get into the regular daily show, where I run you through all the latest financial news, data and charts from the markets today, first I want to explain a bit of what I offer on here in addition to my daily market show. And so for the last 8 years, I've been a premium member on the TradingView charting platform, which is the #1 charting platform online. With tens of millions of active users every day, they offer charting and other tools on pretty much every single financial market and asset in the world. And the cool thing about the TradingView platform is it allows you to create custom indicators by using a wide range of data. And so it's allowed traders to take technical analysis to a whole new level. And over that time I've been on the platform, I've developed over 20 unique custom indicators that I use myself. And part of the reason why I started this Click Capital channel was to not only share my knowledge and experience in the markets, but also my custom indicators with you guys as well. And so I've already got hundreds of traders who use my indicators every day, and anybody can get them from my website, clickcapital.io, and by coming over to the indicators page. And on this page, which I'll put a link to this in the description below this video, you can watch a video that explains in detail all of my indicators and how you can set them up and best use them. And also on this page is descriptions for each of the indicators. And so I've got 20 custom indicators, and in total value they're $850, which I normally sell as a package for $497. However, if you haven't already, subscribe to this YouTube channel, because next week I'm going to offer a special deal where you can get lifetime access to all 20 of my custom indicators for TradingView, including my 2 new ones, dark pool percentage and optimal stock bond allocation, for the one-time fee of $237. All you need to use these indicators is a free TradingView account, and there's no other ongoing costs from me or sneaky upsells or anything like that. It's just a one-time fee and you'll have lifetime access to all 22 of my custom indicators, plus you'll get all future indicators I develop free of charge as well. And these are indicators I use every day in my own trading and to manage my own portfolios, and that includes my strategy on the Collective 2 marketplace called Only Bears. And this is a unique product, this strategy, because it only shorts stocks. It's always got 20 short positions in the US stock market, and it's designed to complement most people's long-only portfolios, because we get the big market correction, recession or crash, then my strategy will significantly outperform. However, even though the market is already up 16% year to date, my strategy is up almost 20% year to date, and all of my trades are entered in real time into this platform and tracked independently by them. And these results include the monthly cost to follow my strategy too, which is $75 a month. So this is proof that my indicators do work. And just to give you an example of how I use my indicators to find really great trades and investments, is 2 I use a lot for my Only Bears strategy, and that's stock fair value and business quality score. And so the difference about these indicators compared to other ones is they're fundamental indicators. They're not just looking at technicals, they're looking at a lot of things to do with the business, the balance sheet, forward earnings expectations, and other things like that. And so one of my short positions in this portfolio is that in Roblox, which I shorted back on the 29th of March at $43 a share. And that was back up around here. And if you look down here in the stock fair value, when I hover over that, you'll see my stock fair value indicator had it at $17 a share, and we were trading at 43. And the business quality score was showing really weak too at -32. So that, in addition with my technical indicators, which was showing a bearish divergence, stalling out near resistance, gave me the confidence to pull the trigger on the short, and I'm still holding it short here today, as I still think it's overvalued, as my stock fair value indicator has got it at $12 a share now. And this indicator is dynamic, it changes every day, and basically I'm shorting stocks until I get down near fair value and I find something else a lot better to replace it with. So stick with me today. I'll get a bit into some other indicators like the new dark pool percentage indicator, which I'm really excited about. I think it's the best indicator I've developed so far. A lot's gone into it, and I think it gives insights into stocks and ETF that you just can't get anywhere else. So like I said, if you haven't already, hit that subscribe button, and next week I'll let you know how you can take advantage of this special offer to get all 22 of my indicators for just the one-time fee of $237. And stick with me today. After I get you up to speed on all the latest developments in financial markets today, I'll show you a bit more of my dark pool percentage indicator and how you can use that to get unique insights into what dark pool traders are doing in each stock out there. So here we are in my regular chart layout. And all the indicators you see on the chart are my own custom indicators included in the package as well. And we can see the market was pretty flat today, just up a little bit. And it's kind of sitting in this neutral middle zone here and calling up a little bit. And just taking it out to a weekly chart on the S&P 500, we did finish the week down 1.2% and on the Nasdaq down 1.3%. So it appears we're consolidating and stalling out a bit here near this resistance zone. And just running you through some bullish arguments for the market out there. This analyst is saying the market's September blues are nearly over, why stocks could gain 5% from here. And even though September is historically the worst performing month in the stock market, some analysts are saying to take a step back and look beyond September, as the worst of the late summer turbulence might already be behind us. They go on to say performance in the 3 months following the close of the 8th of September have been among the best relative to any rolling 3-month performance throughout the year. And for that 3-month time frame, the S&P has registered a median gain of 4.65%. We've also got noted investor out there, Ken Fisher, saying don't be fooled, this bull market has legs. And 2 stocks he's using to bet on a bounce is Charles Schwab, in which he holds a big position. And that had been beaten down after the regional banking crisis in March and did get pretty cheap. And the second one he's betting on is Intuitive Surgical. And he's saying the opportunity that company has in China is significant and also holds a large position in the stock. Even the Fed's own economists are expecting a Goldilocks scenario. No recession, low inflation, and positive growth. They're saying further rate hikes may not be needed and inflation could dip below 2% by next year, which is a very optimistic outlook and one the stock market would love as well and is kind of already banking on. However, let's take a look at the other side of the coin and the risks out there. One of them being 7.6 trillion of US government debt will mature in the next year, and that adds upside pressure on rates because that is a huge amount, 31% of all outstanding US government debt. And basically what that means when that debt matures is the government's going to have to refinance it and issue new debt, and just simple supply-demand economics. If they're trying to sell a lot of bonds, it's going to have to offer a higher yield to attract buyers. And don't forget, we're coming up to a big corporate debt refinancing wall next year as well. So that government debt will have to compete with corporate debt for investors' capital, and that should help keep upward pressure on rates in the actual market for debt. The other risk out there is the stock market's really not pricing in a surprise from inflation. Stock market's kind of trading as if inflation is going to keep marching down towards 2% and we don't need any further rate hikes. However, what could upset that scenario is the strong price action in commodities, which are a large cost input into the economy, especially oil, which is now closed at a new high for the year. And that's on the back of production cuts being extended through December from 2 of the world's largest oil producers, Saudi Arabia and Russia. And that's making some people, myself included, and others like an economist I respect, Mohammed El Iran, saying the Fed won't raise interest rates this month, but rising oil prices could spur a future increase. And he says the Fed's going to keep the door open for at least one more rate hike in the future. And according to him, there's 2 reasons why they're going to do that. The first being the economy is proving stronger than they had anticipated. And the second is we're seeing major moves in oil, iron ore, certain food items. They are supply driven, and that's going to go into headline inflation and could even spill over into broader issues. And so we haven't seen a meaningful tick up in inflation yet, but we're already seeing a little bit of softness coming out of the jobs market. And another sign we're seeing that is that wage gains are slowing for job hoppers. And that's the wage gains for those switching jobs are now just barely higher than those who stay in their current role. And so that had been a trend of late, especially after COVID. With switching jobs, people could often find a higher pay. And that created a huge gap between people that stayed in their job. However, that's almost completely lost now. And basically the jobs market is like this headline here. It's clearly slowing, but it's still strong. So it's been showing some signs of softness. We did get that bump up in the unemployment rate. It is now above the 20-month moving average, which is a key recession indicator. And we're seeing those non-farm payroll continue to trend downwards as well. So things could be on the verge of turning here in the labor market. And the Fed really doesn't want to see any more upticks in inflation because they just kind of want to hold rates here for a while and see how the most aggressive rate hiking cycle in history plays out through the economy, because there's normally up to a 12-month lag on rate hikes. So if oil keeps ripping higher, that is going to add a level of complexity to the Fed's job and could change the whole soft landing Goldilocks scenario narrative quite a lot. And we've still got other things out there like the September 30 deadline for Congress to pass a new budget, potential government shutdown. It's prompting former Goldman Sachs strategist to say the chances of a US recession are rising. And that's because a big driving factor in the economy, government spending, is now a political issue and is likely to have downward pressure on it over the coming years. And so I think next week is pivotal for the stock market and kind of its sentiment and whether we can break out to fresh highs. And that's because we've got Apple set to release their latest iPhone 15 to the market and hopefully get their sales back to growing again, because the last couple of quarters Apple sales have actually been down year over year. And so obviously we all know how important Apple is to the market, being the largest stock out there and making up large percentages of the S&P 500 and NASDAQ. And so the prices for their iPhone 15 base model and the Plus model are expected to be unchanged at $800 and $900. However, we're expecting a $100 increase and $200 increase on their Pro and Pro Max models. They're likely to introduce a few other things, including new watch, but I don't think we're going to see anything new in the terms of Mac products. And one of the big new things expected with the new iPhone is a titanium case that should be stronger and lighter than stainless steel, an improved camera, and I'm sure a few other little things as well. And so that's getting some research analysts hopeful and optimistic. This can get Apple growing again and investor sentiment positive, and their stock can rally back up to highs. However, it's no coincidence that just as Apple is about to release their new iPhone 15, China's come out with new rules, doesn't want their government employees and even state-run firms using iPhone products anymore. As Apple is the biggest pawn in the US-China economic Cold War, that looks to be escalating all the time. And so just looking at the daily chart of Apple's stock here, it did gap down quite hard after that initial news of the Chinese ban on government employees using iPhones. And we did get a little bit of a bounce here today. But what's interesting is looking at my latest indicator for TradingView dark pool percentage is showing that dark pools on average are buying this dip, just like they did back in mid-August after Apple's disappointing earnings result. And so for those of you who don't know, dark pools are private exchanges and kind of dealing points where typically large traders, hedge funds, billionaires, family offices, and other sophisticated traders like to do their trades in large blocks. And why it's called dark is because you can think of the normal exchanges like the NYSE and NASDAQ as being lit, where everything is out in the open and clear, whereas dark, it's a bit more buried. There's not a public order book. Regulation does require them to report trades, and I'm really proud to bring this dark pool percentage indicator to TradingView and you guys. It's something I've been working on for quite some time and something I've wanted for a while and hasn't been all that easy to code. And I've come up with a unique way to estimate the percentage of dark pool volume that is buying. And so today the reading's 57%, which is just in the bullish zone above 55%. Between 45 and 55%, we'll have it colored orange, and that's kind of like a middle zone where I wouldn't say the dark pools are either too bullish or bearish. And under 45% of buying volume in dark pools is what I consider bearish, and that'll be shaded in the red. And you can go back in time on any stock, and it's quite remarkable how good the dark pools are at buying the dips and pulling back when things are getting a bit toppy. And this indicator works on all US stocks and ETFs. And there are other companies out there that do compile dark pool data. However, it's typically very expensive. The company I was previously using charges $720 per month to get access to their dark pool data. However, like I said before, stay tuned because next week you're going to get the chance to get all 22 of my custom indicators for just the one-time fee of $237, and that includes this dark pool percentage indicator here. And that's with no ongoing costs. And I think this is my best indicator that I've made to date, as it gives really unique insights into a stock other than just technical analysis as to what some of the biggest, best, and most sophisticated traders are doing out there. And stick with me, I'll give you some more examples of this indicator throughout this video and what it's showing for some other key assets we follow as well. Just moving on throughout the daily show, we can see market breadth here was pretty checkered today. A lot of spots of green and red out there, with the energy sector continuing to hold up the best out of all of them. There wasn't much out today in terms of economic data. We did get some jobs data from Canada, showing that their jobs market is holding up pretty good, with the employment change coming in just below 40,000 jobs, and that was more than double expected, and their unemployment rate actually ticking down a notch to 5.5%. Looking out to next week, we don't have too much to start the week off, but getting into the week on Wednesday, we do have the big one, CPI, core inflation rate, that we'll be really watching and could move markets. Then on Thursday, we got some core PPIs, retail sales, weekly jobless claims, into Friday when we've got a little bit of manufacturing and production data coming through. Market switching back and forth as to whether the Fed is going to hike in November or not. Now saying 55% chance they'll stay on pause. And that CPI data we got on Wednesday is likely going to alter these probabilities as well. Stock market's kind of in a neutral middle zone at the moment. We can see that in the fear and greed index sitting at 51, and it wasn't really a busy day for a Friday on the options market, coming in at 38.1 million contracts traded. slightly more calls than puts at 53%. And the gap between corporate insiders selling their stock and buying their stock continues to remain significantly higher towards the selling. And just looking at my indicators for the S&P 500, dark pool percentage is at 41%, looking like they're still net sellers. And the S&P 500 oscillator sitting right in the middle at 50 as well. So we can see they dip bought the market back on the 18th of August. My S&P 500 oscillator went into oversold territory as well. Then just as we're getting a little bit overbought here, they really pulled back, and we've pulled back a little bit since then as well. And now we're kind of just in the middle zone, but doesn't look like there's much dip buying going on. Similar story in the NASDAQ. Dark pools appear to be sitting in a middle zone, but appear to be a little bit more bullish in the Dow Jones Industrial. And just moving through all the charts today, we've got the international stock indices. Still pretty flat as well. We had a few finish a little bit higher on Friday and a few finish a little bit lower. And another typical Friday in the VIX market, finishing lower here. Now on a 13 handle. And there's a look at breadth in the market. 39% of stocks above their 20-day average. But we now have the majority of stocks below their long-term 200-day average. And more signs of deteriorating breadth and stocks making new lows versus new highs. Another pretty good gap today on the NASDAQ. 95 new lows versus 23 new highs. And the growth versus defensive sector stock spread may be playing out a double top formation here. Pulled back again today. Another bit of a pullback in high beta stocks. And looks like small caps versus large caps just lost that support zone we've been watching. And that's a bit of an indicator that breadth in the market is continuing to deteriorate, because the Russell 2000 is a much more diverse index compared to the S&P 500 that's concentrated with mega cap tech. And same with global growth expectations as expressed through the copper versus gold commodity spread. That continues to trade down and has been in a downtrend pretty much all year. However, what has grown a bit this week has been inflation expectations, as we can see through the spread between inflation-protected treasuries versus regular treasuries. And yields continue to remain firm, with the 2-year government bond yield just hovering below 5%, and the back end of the curve holding up pretty good as well, with the 10-year at 4.26%. And so if the Fed is almost done hiking, maybe they've got one more hike left in the bag, unless we get a real surprise on inflation with oil. However, that could be counteracted by a softer jobs market, which oil may actually help cause. Just taking you out to a clean monthly chart of the 20-year Treasury bond ETF TLT, probably one of the most known and popular bond ETFs in the market. That's just coming off the back of the worst 3-year performance it's ever had, and the worst 3-year performance in the bond market going back 150 years, and looks to be forming a potential double bottom. And we can see last month finished on a big hammer formation, and we're right down the bottom of this range here at 94. So this could be a really good risk-reward spot to add some long-dated treasuries into a portfolio, because if the Fed is done and they cut rates next year, just like the Fed fund futures market is forecasting, then this fund here, TLT, is likely to be back above 120. Also offering a yield of 3.5% per year in dividends, and a great hedge for a typical long-only equity portfolio. Because if anything else surprises or upsets the market, there'll be a flight of safety into bonds, driving down yields as well. And so technically and fundamentally speaking, TLT could be a good risk reward here for a medium long-term play in a portfolio. What's also caught my eye is dark pool activity in the fund, and we're seeing the most amount of green in TLT that we have seen in a while. And in fact, on Wednesday's reading in the dark pool percentage indicator came in at 71%, which is very bullish, and it's the highest reading we've seen in quite some time in this fund. And so that looks like they have been buying the dip over this last month, and a bit more buying going on overall this year than not. And if we just scroll back in time, looking at this fund, we can see back here in mid-late 2021, they were doing a lot of selling into this range at these prices when TLT was around $150 a unit. And that also coincides with my latest indicator included in my indicator package, available next week, and that's optimal stock bond allocation. And back during that time, the dark pools were doing a lot of selling in TLT. This indicator was also recommending a low allocation to bonds. It even started back in 2020 when TLT was even higher. And so bonds were a lot more overvalued relative to stocks back then. However, that's all changed now that rates are higher and the stock market's still near all-time highs as well, with corporate earnings having contracted for 3 quarters in a row. And so now, for the first time since 2007, my indicator is recommending a heavier allocation of bonds than stocks by a margin of 13 percentage points. So here we are today with technical signs we may be nearing a bottom on long-dated treasuries. The market actually pricing in a slightly higher probability than not that the Fed is done, and is hard to imagine the Fed does have more than one rate hike left in the bag, as we are seeing a jobs market softening. And even though we've got oil on the march higher, which does put upward pressure on inflation itself, That may also cause a pullback in consumer spending, further job losses, and may offset the negatives of higher oil price and also cause oil to pull back itself along with inflation. Then the Fed can declare victory, tell the market they're going on pause, and then when the jobs market does finally and inevitably fall apart, they'll cut rates, and then we'll see bond prices rally as yields drop. So there's a few indicators saying that now may be a good risk reward on TLT. And we're seeing no signs of stress in credit markets because we can see that in high yield corporate bond prices, which have been going sideways pretty much all year. And those higher yields are helping to keep a bid in the dollar as well, now sitting pretty at 105, which appears had an effect on the crypto market and Bitcoin having traded pretty weak this last month, but hasn't really damaged commodities at all. Commodities have actually managed to rally at the same time the dollar index has rallied, just showing how strong commodities really are. And that of course is being led by crude oil, which is really holding up strong at $87.50 a barrel and sitting above this resistance zone we'd been watching for a while, and we'll be looking for that to turn into support. And gold, even though it's been going sideways for a couple of months, that's been holding up pretty good in the face of a strong dollar. Same with agricultural commodities as well. And the price of your orange juice is just about to get more expensive again as we are hovering near new all-time highs. And just over to stock sectors today. Still got the meme space coming off. The winner today again was the cannabis ETF. At one point today we were up over 10%. Briefly getting above $9 a unit. However, we finished the day up 3.88% and on a shooting star candle formation in a significantly technical overbought area. And we can see that with a few indicators here. The first being this reversal signal. That's another one of my indicators included in the package. We're also well above the buy-sell band here in this red line. And we can see the dynamic swing index showing a big reading at 20. So this is technically overbought. We could easily expect a pullback towards the 50-day VWAP in this white line here. And we can see in my VWAP indicator, we're currently 37% above the VWAP, which is actually near one of the extreme readings. However, I can imagine because of all the fundamental developments in the cannabis sector, there is a lot of money on the sidelines waiting to buy the dip. So any dips we do get back down below $7 a unit may not last for long, and we may get that quick dip buy back up. As hopefully this is the start of many more good things to come. And for those who regularly watch my channel, you know, I got back into this fund in mid-June at $5.48 a unit, and I'm holding this as a medium-term tactical position with an event target being federal legalization and hopefully a lot of media hype and mania at the time, and I'll be looking to sell into that. So hopefully that happens before the elections next year in November. Moving on, we've got the AI ETF bots continuing in a short-term downtrend, and the sentiment in this kind of theme and story this year looks to have really come off the boil now, with a lot of the smaller stocks in the space trading down, and even the big one itself, the semiconductor sector, seems to be having trouble to breaking out to new all-time highs. It's actually been building this big negative bearish divergence for the last couple of months. Same with overvalued stocks that ARK Innovation ETF holds. That's struggling to come up to highs. There's a look at consumer discretionary stocks. Retail's weak, and one of the best performing sectors this year, home builders, looking to be putting on some bearish divergences. And what had been the leader up until a couple of weeks ago, industrials, also trading below the 50-day VWAP in a short-term downtrend. We did see financials hold up a bit today, and the best performing sectors in the market, energy and oil and gas, actually found new year-to-date highs. We also had aerospace and defense stocks trading near new all-time highs, but continue to trade in this really long, big range. And the defensive sector is still just holding up a little bit here today. We got a little bit more of a pop out of utilities after we did get a bit technically oversold earlier in the week. Just moving on to popular stocks, there's BlackRock, pretty much flat today. Same with JP Morgan, and that looks to be getting into a technically oversold level, and we can see that on our DSI below this green line here at -10, and a little bit of a positive divergence on our hidden divergence indicator. And just looking at the dark pool indicator, there's been a lot of buying in JP Morgan this last couple of weeks. There's Microsoft, still a little soft, and NVDA just closed below its 50-day VWAP today. And another thing I just noticed a few days ago is NVIDIA founder and CEO Jensen Huang just sold over $42 million worth of NVIDIA stock at an average price of $485 and $471 a share. And this was just after their recent earnings release, which they did come in with a blowout quarter, beating EPS estimates by almost 30%. We did gap up above 500, but put in a big dark cloud cover formation, kind of a rejection from that level, some big money obviously selling into it. And this one is key to the market, like you've been hearing me talk about. For the NASDAQ to break out, we really need NVIDIA to break out and kind of lead the way, along with Apple and their new iPhone. However, it looks to be getting rejected from that $500 level, and this big reversal candle here may just be the start of something and play out to the downside. And again, looking at my dark pool percentage indicator, there hasn't been a whole lot of buying in NVDA apart from a brief buy the dip back in early August. It's been mostly selling at these levels as well. There's a look at Tesla, still coiling up at its 50-day. And over to the meme space, another down day. AMC continues to get hammered. There's GameStop down another 6%, and that's one of our short positions in the only bears portfolio. As my stock fair value indicator's still got fair value at GameStop at $9.75 a share and negative business quality score. So I'll be looking to cover my short in GameStop, probably in the single digits, around $10 a share. And just looking at the beaten down telecoms, AT&T still showing good value at 51% undervalued, and Verizon with a higher business quality score and 41% undervalued. And Dark Pool's doing a lot of buying in Verizon as well. And it's not much surprise because with a dividend yield just under 8%, which some analysts have shown they can uphold, is a pretty good and safe yield there. And just looking across the regional banks, got a nice little pop here today, and even in the big guys as well, with Charles Schwab up 2.6%. Okay guys, that's pretty much a wrap for today. Like I said, stay tuned for next week because I'm going to be offering you all my 22 custom indicators for TradingView that I've spent years and thousands of hours on researching, creating, coding, testing, tweaking, and I use every day to manage my own portfolios and the independently tracked only bears portfolio, up almost 20% year to date, along with my own personal swing trading portfolios, long-term investments and retirement portfolios. You too can get lifetime access to all of these indicators that I use every day. I don't really use any of the free indicators most people out there use. You can get some of these indicators that you won't find anywhere else. Fundamental indicators like the stock fair value one, other ones like seasonality forecast, smart sizing, the S&P 500 oscillator, the dynamic swing index, reversal signals. I've got an indicator for option traders, the sector trends table, and for day traders I've got the momentum scalper that you can use for real-time alerts. All my indicators are super easy to set up and use. I offer ongoing customer support. You get all future indicators free of charge. And if you do change your mind, I offer a 7-day money-back guarantee, no problems at all. All you need is a free TradingView account to use them. And like I said, I'm offering more than 50% off. The normal price of $497, just be a one-time fee of $237 to get all my custom indicators. So I'm excited to share that with you guys. And I have even more cool stuff on the way that I've already started on. And this will be the last time I sell these indicators for this cheap. So like I said, take advantage of this special offer next week and you'll get all my future indicators free of charge as well. Just as people who have previously purchased this package will get them free of charge added to their account starting next week as well. Alright guys, that's all for this week. Thanks very much for staying with Click Capital and me. I really enjoy making these videos for you guys. They also help myself as a trader investor as well. And I look forward to bringing you another show on Monday afternoon. Have a great weekend guys. Cheers.